What's the best way to start investing online with just $100? As a millionaire investor, I'm often asked this question. I decided to find out by investing $100 in 5 different things: stocks, REITs, crypto, gold, and index funds. Today, we'll compare the results and finally answer which option is best. Stick around until the end because the results might surprise you, especially if you're wondering which methods grew $100 the most. How we'll compare investments to keep things fair. We'll rate each investment based on these categories. 1. Learning curve. How hard is it to get started? 2. Passive income potential. Can this investment make you money without constant attention? 3. Tax efficiency. Are there ways to reduce taxes on your profits? 4. Risk level. How likely are you to lose money? 5. Results. How much did my $100 grow over the last 4 years? Let's jump in. 1. Individual stocks. What are they? Investing in individual stocks means owning a piece of a company you believe in. For example, companies like Apple, Samsung, or Nvidia. Learning curve. High, you need to understand a company's financials, leadership, and industry trends to succeed. This isn't a guessing game. You must analyze balance sheets, income statements, etc. Apps with demo accounts like Trading 212 can help you practice risk-free. Passive income potential. Good stocks can make money in 2 ways: price appreciation and dividends. Not all stocks pay dividends, but they can be a nice passive income stream when they do. Tax efficiency. Great using tax-advantaged accounts like ISAs in the UK or Roth IRAs in the USA can protect your gains from taxes. However, make sure to check local rules as they vary by country. Risk level. High stocks can be volatile. For example, I made significant investments during the dot-com boom, but others went to zero. Diversifying and staying informed can reduce risk, but no stock investment is entirely safe. Results: 4 years ago, I invested $100 by randomly selecting stocks. My dart landed on Samsung. Today, that investment is worth $67.66. Adding dividends, my total is $67.76, a negative 32.34% return. However, had I picked Nvidia, that $100 would now be worth $908. This highlights how individual stock investing can be a hit-or-miss strategy. Key takeaway: stock investing can be rewarding but requires careful research and strategy. 2. REITs, real estate investment trusts. What are they? REITs let you invest in real estate without buying physical property. Think of it as pooling money with others to own and profit from rental properties. Learning curve. Moderate. Getting started with REITs is more straightforward than buying physical property. There's no need for large down payments or dealing with tenants. However, you'll need to understand the types of properties a REIT owns and how they generate income. Passive income potential. Great REITs are famous for their high dividends. They're legally required to distribute 90% of their profits to investors, making them an excellent source of passive income. Tax efficiency. Great in countries like the UK, you can hold REITs in a tax-advantaged account, shielding your profits and dividends from taxes. Check local rules for specifics. Risk level. Medium REITs are generally less risky than owning individual properties because they diversify across multiple buildings. However, downturns in the real estate market can still impact performance. Results. Invested $100 into a REIT focused on commercial properties 4 years ago. Today, it's worth $98.59, a slight 1.41% loss. However, after receiving $11.93 in dividends, my total return is 10.52%. Key takeaway: REITs offer steady income and diversification, but aren't immune to market downturns. 3. Cryptocurrency. What is it? Crypto is a digital currency like Bitcoin or Ethereum that operates without central banks. It's built on blockchain technology and is known for massive price swings. Learning curve. Moderate, you'll need a wallet and a platform to buy crypto, like Coinbase or Binance. It's essential to research coins and understand concepts like staking and tokenomics. Passive income potential. Moderate crypto doesn't pay dividends, but you can earn rewards through staking or yield farming. be cautious. These methods come with higher risks. For safety, I prefer holding Bitcoin on a hardware wallet. Tax efficiency. Poor crypto is heavily taxed in most countries. Even swapping one coin for another can trigger taxes. Unlike stocks or REITs, crypto can't be held in tax-advantaged accounts. Risk level. Very high crypto is one of the riskiest investments due to its volatility and lack of regulation. While Bitcoin and Ethereum are more stable, smaller coins can be incredibly speculative. Results 4 years ago, I invested $100 into Bitcoin. Today, it's worth $652.24, a 552.24% return. While impressive, remember that crypto's past performance doesn't guarantee future results. Key takeaway. Crypto has high risk but offers high potential rewards for those willing to stomach the volatility. 4. Gold, what is it? Gold is a classic investment used to protect wealth during uncertain times. You can invest in physical gold or gold ETFs. Learning curve. Low investing in gold is straightforward. Physical gold needs secure storage, while gold ETFs can be traded easily online. Passive income potential. None gold doesn't generate income. It's purely a store of value. Tax efficiency. Good. Some countries offer tax advantages for specific types of gold, like the UK's tax-free Gold Britannia. Gold ETFs can also be held in tax-advantaged accounts. Risk level. Medium gold is stable but doesn't grow as fast as other investments. It's ideal for preserving wealth rather than rapid growth. Results 4 years ago, I invested $100 in gold. Today, it's worth $140.10, a 40.1% return. This is solid, but less exciting than crypto. Key takeaway. Gold is reliable for preserving wealth, but isn't a fast growth investment. 5. Index funds. What are they? Index funds are stocks designed to track a market index, such as the S&P 500. They're a simple way to invest in the overall market. Learning curve. Low index funds are passive and beginner-friendly. You don't need to pick individual stocks, just buy the fund and let it grow. Passive income potential. Moderate index funds pay dividends from companies within the fund, but their main appeal is long-term growth. Tax efficiency. Great index funds are highly tax efficient and held in tax-advantaged accounts like ISAs or IRAs. Risk level. Low index funds are diversified across many companies, reducing risk. They're one of the safest long-term investments. Results: I invested $100 in an S&P 500 index fund 4 years ago. Today, it's worth $179.57, a 79.57% return. This consistent growth is why index funds are a favorite among investors. Key takeaway. Index funds are low risk, steady investments perfect for beginners. Final thoughts. Each investment has pros and cons. Stocks, high risk, high reward, but requires research. REITs, reliable income but affected by market conditions. Crypto, massive potential but highly volatile. Gold, stable but limited growth. Index funds, low risk, consistent returns. The best approach is to start early and diversify. Even $100 can grow significantly with time and smart choices. If you're ready to explore more ways to grow wealth, check out my next video on the laziest way to make money online. Don't forget to subscribe and hit the like button. See you in the next one. If you find this content valuable, please like, subscribe, and hit the notification bell to stay updated with the latest finance and global trends. Share your thoughts in the comments below.